Have you ever noticed that every time the stock market crashes, gold suddenly makes headlines? It doesn't matter whether it's the 2008 financial crisis, the 2020 pandemic crash, or even smaller market panics. Gold always seems to shine when everything else falls apart. But why is that? Why does gold, of all things, become the safe haven for investors when the world looks uncertain? In this video, we'll break it down step by step: the history, the psychology, and the modern case. Studies that explain why gold prices spike every time markets panic. By the end, you'll know exactly why investors run to gold and whether you should consider it during the next crisis. Gold has been considered money for thousands of years. Long before dollars, euros, or yen existed, gold was the universal store of value. It doesn't rust, it doesn't corrode, and it's rare enough to be valuable, but abundant enough to be tradable. That long history matters. Investors have built trust in gold over centuries. When people are uncertain about paper money, banks, or governments, they instinctively turn to gold. Think about it this way. A stock represents a company. If that company collapses, the stock can go to zero. A bond represents a government's promise to repay debt. If the government defaults or inflation erodes the values, you lose. Gold doesn't rely on anyone's promise. It just sits there, holding value because people believe it will. This is what makes gold a safe haven. It's not about growth, it's about preservation. When panic sets in, people stop worrying about maximizing gains and start worrying about not losing everything. Another major reason gold spikes during crises has to do with inflation and currencies. Gold is priced in US dollars. That means when the dollar weakens, gold often strengthens because it takes more dollars to buy the same ounce of gold. During crises, central banks often step in and print money, lower interest rates, or inject liquidity into markets. While that can calm markets temporarily, it often raises fears about inflation. And here's the psychology. When investors think the dollar, or any currency, is losing value, they look for something that can't be printed. You can't print gold. There's a limited supply. Take the 1970s, for example. Inflation in the US skyrocketed, oil prices were soaring, and the dollar's value dropped after it was taken off the gold standard in 1971. What happened? Gold went from around $35 an ounce in 1971 to over $800 by 1980. This is the classic hedge. People buy gold not because they want explosive returns, but because they want protection against money losing its purchasing. The power. Now here's something important. Gold prices don't move simply because the supply changes. Gold mining production does increase over time, but very slowly, only about 1 to 2% per year. So why does the price spike dramatically during panic? It's demand, and more importantly, psychology. Markets run on emotion as much as fundamentals. In normal times, investors chase stocks, bonds, or real estate. But when fear takes over, the psychology flips. Suddenly, safety is worth paying extra for. It's similar to how people rush to buy bottled water before a storm. Water is always available, but in a moment of fear, demand spikes instantly. Gold works the same way, and because the supply can't adjust quickly, the only thing that changes is price. That's why you see sharp moves upward whenever investors collectively panic. Let's look at a few recent examples to see this in action. During the 2008 financial crisis, when Lehman Brothers collapsed, global markets went into chaos. Stocks were falling daily, banks were failing, and no one trusted the financial system. Gold initially dipped because investors were selling anything they could to raise cash. But once the dust settled, gold began a massive rally, climbing from about $700 an ounce in late 2008 to over $1,800 by 2011. In the 2020 pandemic crash, markets had their fastest drop in history. At first, gold also dipped because investors were desperate for liquidity. But within months, gold hit record highs above $2,000 an ounce. Investors wanted a hedge against the uncertainty of global lockdowns, stimulus spending, and potential inflation. Then in 2023, when Silicon Valley Bank failed, fears spread about the entire banking system. Where did investors run? Straight into gold. Prices jumped again, proving that in modern times, the safe haven instinct hasn't gone away. These examples show the same pattern. Panic leads to demand for gold, and because supply is relatively fixed, the price rises. Now, it's important to be realistic. Gold isn't a perfect investment. Yes, it spikes during crises, but it can also stagnate for long periods. For example, after peaking in 1980, gold entered a bear market that lasted almost 2 decades. Investors who bought at the peak had to wait 28 years just to break even. Unlike stocks, gold doesn't pay dividends. Unlike bonds, it doesn't pay interest. It's not about generating income. It's about preserving value. So the role of gold in a portfolio is not to replace everything else, but to act as insurance. Just like you don't expect your car insurance to make you money, you don't buy gold expecting it to outperform stocks over decades. You buy it to protect against the worst case scenarios. So why do gold prices spike every time markets panic? Because it's the oldest and most trusted safe haven. Because it protects against inflation and currency weakness. price. And because psychology and fear drive demand when everything else looks risky, history shows us that in every major crisis, from 2008 to 2020 to 2023, gold shines brightest when fear is highest. And that's the key. Gold isn't just a metal. It's a symbol of trust in a world full of uncertainty. So the next time you see markets in chaos and headlines screaming about panic, watch what happens to gold. Chances are, it'll remind us once again why it's called the ultimate safe haven.